Welcome to the Rigatoni Capital Podcast. It is in the morning, March 11th. It is a bright and sunny and warm day on Wall Street. And we just had CPI come out. And we also had Oracle's earnings last night. And also breaking news, I'm back to cold brew because I have a bad addiction. And yeah, it's not good because it's expensive to drink cold brew every day from Starbucks. So I want to talk about Oracle. I want to talk about CPI. I want to talk about a bunch of stuff. I haven't made any moves to my portfolio. In case anybody had watched the last few podcasts, I was pitching both Goldman Sachs and American Express and the Freedom ETF, which was, it's not financial advice. I was pitching it to explain how I'm not buying it. So how is that even a pitch? But they are all on my radar and they continue to be on my radar. And as you can see, headline news: US core CPI tumbles the slowest in 4 years before Iran triggered oil spike. Looks like headline CPI is up 2.4% year over year. And that says it is unchanged from the prior month at the lowest since May 2025. I like this chart here. If you can see it on the screen, we can see that we continue to have like a consolidation area here, but we're trending down and we've been trending down since 2023. So now, of course, we know that gasoline prices are going to impact the CPI. And we know that gas prices year over year in the February CPI report that we just got, year over year, gasoline's down 5.6%. And remember, this is not a core CPI, so it includes some good stuff in here like food and food at home up 2.4%. Overall CPI is 2.4%. Shelter's up 3.0%. That's rent. And you have nobody like me, I don't pay attention to new cars, used cars, but used cars are down. And then you have your electric bills always up, your medical care bills always up, and your fuel, oil, and gas utilities are up nicely. So I don't take the CPI too seriously because remember, it's a bucket that the Federal Reserve determines what should be in it, or a third party that determines what is in the pile and what weighting should go to what. So don't you think that's kind of convenient? And then I'll show you again algotraderalert.com from last night. Like I say, I would subscribe to him on Substack because I really like his breakdown. How he just, it's a really quick breakdown on the day's news. And I like this section. He says the Treasury curve saw a slight steepening, mainly due to a 6 basis point increase in long-term yields. The 30-year Treasury yield rose to 4.78%. This increase was partly due to a surge in high-grade corporate bond offerings after limited activity in the previous section. The 2-year yield, which is sensitive to policy changes, also increased slightly from 3.56% on Monday to 3.57%. It doesn't seem a lot, but I think it's good to be reminded to look at the 2-year as well as the 10-year, which we only look at here, Rigatoni Capital. And then we talk about WTI, we talk about gold kind of like holding firm here. Gold and silver, if you look at the chart, doesn't look like they're going to break down further. It looks like they're still trending up. It's unbelievable. Bitcoin held steady, trading above 70,000. Yeah, I think we're in this new little choppy area here, but you never know what Bitcoin's going to do. And of course, the VIX finally came down back to a little bit of earth, although it's still over 20 and it should be, I think, don't you? And we can look at the VIX here. As you can see, we really broke through and went up in the low 30s, and the VIX is now trading at 25% at the moment, 25 and a half. At Income Sharks on X says VIX. If you can see the photo, it says VIX. It's amazing how well this range gets respected. So anytime you go above that green line I just showed you, which is like around what, anytime you break at least 30 or you break 28, 25, this VIX, there's a big group of investors that buy probably this VIX spike. They buy stocks. And it goes back to the times we have gone there. And then this is my whole point, is that when the VIX spikes and you buy stocks, yeah, I guess it can be a good trade for you. I'm just a little concerned again that the S&P hasn't corrected. So I would prefer both things to occur. I would prefer the VIX to shoot up, and I would prefer the S&P to shoot up for me to get interested in buying stocks. And this guy is kind of saying like, nah, it's just about the VIX. I don't agree with that. And here's the 10-year. Since we were just talking about it, you can see that the 10 years at 4.19% today. So if we can stay in this range between 4.25 and like 4%, I think investors expect that in the 10-year. And then WTI really hasn't done much since the craziest day in history for that bounce that we got on Monday. Look at a 5-day chart. You can see since that occurred, and then the IEA proposes largest ever oil release from strategic reserves. Late last night on WTI is trading at 87, by the way. Last night we found out that there could be mines that Iran is putting in the Strait of Hormuz to spook and slow down the transit, right? So we heard that, and then WTI will react, and then Trump will say, "Don't you dare," and then it'll come back. So WTI is just trading on headlines. And photo of Bitcoin showing you that in the morning before the market opens today on Wednesday, March 11th, Bitcoin is now below 70. So we get these little spikes above 70 and then it sells down. And I think that's normal. I think if you look at a larger long-term chart of Bitcoin, you can see once you get these either big move legs up or big legs down, it takes a few months. Like this one we got in 2025, which was what, like February, when we kind of like corrected in Bitcoin. Didn't take till May for us to kind of come out of that correction. So it takes a few months. And again, I show this to you guys pretty much every day. So you can see Rigatoni Capital. What kind of investor is this guy that comes on here and talks to me about stocks? So as you can see, I really am a buy and hold investor. I try to buy something below its intrinsic value, and then I hold it when it's trading above its intrinsic value. I'm a crazy growth investor. I like Palantir, even though I do agree with everybody that it's way too expensive. I still want exposure to it because I think it's the only way to get this type of AI future exposure where the government and enterprises are really reliant on Palantir. So that's why I bought Palantir. It wasn't because of anything else other than that. And that I think they're a really good company. And as you can see, NVIDIA, I don't know where I'm up today. I might have been up a little. This is as of March 9th. So you can see NVIDIA and QQQ are my largest top holdings. Combined, both of them, I'm up. That's 30% of my portfolio is just NVIDIA and the QQQ. Last night, NVIDIA came out with an article in X called "The AI is a 5-Layer Cake." And I kind of read over this and I didn't think it was anything worth finding. I thought it was like interesting how it wasn't anything new. I didn't learn anything new by this, and people loved it. People thought it was so great. So one thing I thought was cool, or I guess people are using Notebook LM illustration of people's articles. That's really cool. So that was the coolest part of the tweet, is that these people were commenting and they were using these AI illustrations of what the post says. Maybe that was NVIDIA's whole reason of doing this, because they thought people knew of that function. And as you can see, this picture I'm showing you is really cool. It's called AI as Infrastructure, the Industrial Transformation. And I'm not going to read through it because that would be boring, but I would recommend checking out. I'll retweet this but it's breaking down. One is the foundation in energy and chips. That's on the bottom photo here if you're looking at it. Energy, the binding constraint and power source for computation, and the chips. Specialized chips convert power into computation. So you have that infrastructure, industrial, utility, energy type of infrastructure. And then you have the core factories and models. These are industrial AI factories orchestrating thousands of processors to run diverse multi-discipline any array models, disciplinary models. But anyway, if anything, industrial AI factories, I get it. Jensen talks about this, but isn't Amazon an industrial AI factory at this point? I mean, they're more of a logistics warehouse, but and then it shows you the peak. So this is what was cool is that yeah, drug discovery we know about, autonomous systems we know about, like autonomous cars, but it says applications like drug discovery and autonomous systems pull value from every layer below. I thought that was cool the way it was shown here. But anyway, I'll retweet it under Rigatoni Capital, or my handle's like not Rigatoni Capitals. I don't know what my handle is. My handle is at DJ Hot Towns. That was an old nickname of mine back in my glory days. Okay, I got the Oracle earnings. I dug into it a little bit last night. I'm not going to make this a deep dive show on Oracle. That's not what I do. If anything, I just want to tell you how great fiscal.ai is because it extracts the earnings call from the quarter app, but it also gives me an AI summary of both the Oracle's transcript from the earnings call, and it gives me the report as well. And it can give you an AI summary of that too. So I think the biggest number that investors wanted to look for in the market wanted to know like how much more capex is going to happen here because it's getting out of hand. How are you going to fund the debt? How are you going to fund the capex that you're going to spend? So the capex that they projected for 2026 was we all think that's not going to be enough. I think it's 50 billion they said, and we know that it's likely going to end up being more than that. So maybe they're being cautious and letting people know that they are aware of how much an investment this has become. And they also have a backlog. Where is my backlog? Yeah, I think people wanted to know about the backlog, which is $553 billion. And that's linked to large scale AI contracts. So those are the two main things. This company said that Q3 total revenues they beat was 17.2 billion. People were expecting a little over 15 billion. And the market doesn't care about this stuff. The market doesn't care about how well they beat earnings. It's Oracle. This is all about the balance sheet right now. This is all about trying to combat what Michael Burry is saying about Oracle, which Oracle has gotten out of hand and they're never going to make their money back type of stuff. Okay. And here's a photo showing Oracle's Q3 results. We know revenue beat, earnings per share beat, remaining performance obligations, RPOs, is 325%. And Oracle popped on the earnings call as well. And here's a look at revenue from February. I can't read that because fiscal needs to fix this problem. See this problem? But it looks like it's the year 2018, and they're showing you how Oracle's revenue continues to do well. It goes from the bottom left to the upper right. And then this is a photo that says Oracle spent 48 billion on capex over the last 12 months. That's more than Taiwan Semiconductor. And it's showing you the capex jump from 21 billion to now 48 billion. Okay. And then we have Zero Hedge also wrote Oracle jumps on solid earnings and guidance boost despite soaring capex and cash burn. Somebody's like, cash burn? That's not the right thing to say. That this is more than a cash burn. And they obviously saw a very strong cloud revenue and very strong cloud infrastructure revenue. They were up 81% year over year with cloud infrastructure revenue. And of course, the Cloud revenue was up. This is like the SaaS type of the business, the software side. They did really well there. But looks like the cloud infrastructure revenue is what's really humming. And then cloud application revenue, which is another SaaS type of business, up 4.0 billion. Software revenue was up slightly. Software support revenue was up slightly. Software license revenue up slightly. And yeah, but like the big chunks of their segments is this cloud revenue and cloud infrastructure revenue. And let's see. And while the above is all good, what wasn't so good is that Oracle's Q2 CapEx came in at a stunning 18.6 billion, triple the number from a year ago and 50% higher than the Q1 CapEx print. To say that company is spending money is doing a disservice to incinerators. And they talk about the RPO, right? All the back order business they have. And they do project what was really surprising. Here we go. This means that for fiscal 2026, Oracle expects revenue of 67 billion and CapEx of 50 billion. So that's really interesting that they're not increasing their CapEx that much like any other hyperscaler is, right? So I think the market applauded that. That's really why I think most of the reason the stock popped. That's my opinion. And I'm going to tell you right now, I own Oracle, and I'm actually probably green on Oracle. I'm probably up 10% or something. I'd have to check, but it's just not a very large holding for it to be in the top 20. So it gets cut off on my list of my holdings. But yeah, the stock's actually still up 9.5% this morning. All right. So my opinion is that this is about how the balance sheet's going to look beyond 2026 at this point. And that was the main question on the earnings call was, can you give us some kind of projections for 2027? Like more than one guy asked that question on the earnings call. Can you give us CapEx projections for 2027? They asked it twice and they said no, we're not ready yet, but we will soon. And then here's a photo again of Oracle has now burned $25 billion over the last 12 months. So what that means is that this is free cash flow. So they're not going to have any free cash flow for the next few years. Probably 2028, maybe we can start to see free cash flow come back. But yeah, this is the investment cycle. This is a fiscal AI bar chart that I did. I always want to see, for this type of tech company, I always want to see total revenues, consolidated net income, and free cash flow. And you can see the free cash flow continues to look for, excuse me, free cash flow is just a sinking ship right now on these charts. You can see it. That's the whole point. Okay. So is that enough for Oracle? I'm not buying, I'm not selling. I think if anybody can pull this off, this whole AI, CapEx, hyperscale type of thing, I think Oracle can. I think they should be included with the big four. Well, are they the big four? Yeah, so let's add Meta to that list. But I mean, they're like the big five. You have Amazon, Microsoft, Google, and then you also have Meta right now, right? And then you have Oracle. So there's really five hyperscalers, and one of them's not going to figure this out because I think this is a really hard road to navigate. But if you can come out and by the late 28, 29 type of time frame, or even 2030, and you invested all this money and now you have ARR that's crazy, and you can keep your margins that you had throughout this investment cycle, those are the type of company you would have wished that you just held out, even though the free cash flow turns negative. Or it doesn't, free cash flow is not going to turn negative, it doesn't look like, for someone like Microsoft or Google, but they definitely don't have enough money for share repurchase, share buybacks for this whole industrial cycle. And last thing I would mention is that the Mag 7 doesn't look popular, hasn't been popular. The hyperscalers hasn't been popular because of this, but remember, they are going to be coming, if this all works out in the end, they become like Halo stocks because now they own the data centers. Okay. This is a post called Humanity Crossed a Threshold, and most of us just scrolled past it. Two Amazon data centers in the United Arab Emirates were struck down during Iran's retaliation for US military action. Yeah, so if you guys know, like AWS must have had an outage, but we don't know if that had something to do with it. But yeah, they think that striking data centers overseas is a good defense. And my whole point is AWS as a cloud provider, and we see all these outages once in a while, and I think it always brings me back to Bitcoin. Bitcoin definitely cannot be disrupted in terms of a data center getting hit. Because Bitcoin has never shut down since the year 2009 when it started, when it first came on the blockchain. So Bitcoin can never stop running. And why? It's because everybody's running nodes throughout the world. And the entire world would have to either end, or the entire world would have to get bombed and lose electricity. But other than that, it's an international investment. So everybody around the globe is running nodes, and miners are mining. So there's not one center location, and that's what the that's what Bitcoin's all about. Public Bitcoin miners are dumping crypto for AI, a historic mistake. This was written by Zero Hedge. This is a fake news headline, in my opinion. Okay. So first of all, Bitcoin's not crypto, and crypto's not Bitcoin. That's the first thing. But it seems when I read further into this, there's a miner called Cipher Mining. They rebranded to Cipher Digital and diversified nearly half of their mining sites, and they're no longer a Bitcoin company, is what they say. So that's the only dumping that we learned. We didn't learn of any of these miners selling their Bitcoin, but most of the others, and I'll list like Iran, we know Riot, Mara, are signaling hyperscaler leases for unused or future power capacity while still mining Bitcoin. This is not dumping, that is a dual use. So these miners are obviously able to strike deals with these large hyperscalers and data centers, and they still get to mine Bitcoin. It's just they're doing both now. Maybe they're taking less. Maybe they're doing less mining of Bitcoin now because they have another source of revenue and another source of demand. And that's true. But to say they're dumping Bitcoin and just focusing on data center energy, that's wrong. So this headline is really misleading. And I also wanted to show you a photo of Casey's General Stores chart. It's called Casey's General Store chart. Casey's General Store, there's quite a few Casey's. They're like, I don't want to say they were like the Berkshire's Flying J pilot off the interstate. I think it's more like a 7-Eleven Wawa type of thing where the gas station's attached to it. That's how I think of Casey's. And I'm not an expert on convenience stores, but this is a photo of what Casey's looks like, as you can see. It's attached. There's a gas station attached, and you walk into a Casey's, and I believe they're more in the Midwest, and they call them Casey's General Store. So look, I'm not familiar with Casey's, of course. I live in the Philly, New York area, and there's not many around where I am. But obviously, this company has taken care of its shareholders. So I was like, why is this stock such a crazy stock? I mean, people that would have bought Casey's 10 years ago would be retired right now. It's one of the most unbelievable stock charts that I've seen. It looks like O'Reilly. It looks like one of those stocks that just continues to compound and compound. And I looked at share buybacks, and I don't know, it doesn't look like they're shrinking. They are shrinking shares, outstanding shares, but it's not by like a ton. The CAGR is 0.4% over this time frame. And as if you're watching, you can see on the bottom here where fiscal AI is not able to fix this little error. They'll get it fixed eventually, but this must go back 10 years. So yeah, I thought that Casey's was interesting. I'm not going to add it to my watch list because I feel like I missed it. And it's trading over like 40 PE. So again, this type of business, and I'm sure that when gas prices go up, the business does better, kind of like what Berkshire was saying about their Flying J pilot. But I think that a convenience store is not a easy business to own. I think that the problem are margins again in this industry. I don't know how they're getting their product. I don't know the distribution logistics that they're using, but there really isn't a lot of money to make. There's not a lot of profit at the end of the day. Again, this is like my whole point is like Walmart and Costco and this company called Casey's General Stores. They get, yeah, maybe I can show you. I'm not going to show you right now, but the margins they make is nothing fantastic. They're like 3, 4%. But the market doesn't care about that. It does care about how shareholders are being rewarded. The dividend's super small on this. It's not really a dividend play. It is just a play on maybe it's a growth story. And I don't know. I mean, to me, it's not interesting, but people that invested in that stock made a killing. Casey's General Store, the ticker is CASY. I'll at least put it on a watch list with all my stock, all the stocks I look at. But yeah, I didn't really know about this company. Wanted to bring it up. AeroVironment did report last night. I didn't pay attention. I think they missed earnings. Maybe they beat their own internal revenue. As you can see, the revenue really does spike in April 2025. So 2025 they started seeing a huge, I'm sure this is all the Pentagon. So I think they probably got a few new contracts, but as you can see, the company's not profitable. If you can see this company, a ticker AVAV, check it out. People love this company. It's kind of like a meme stock a little bit there, but the company is not profitable. And I'm not an expert on AeroVironment, other than I know that they make these big deals with the US government, like the Pentagon, and then they end up losing money fulfilling it. So they're just, it's not a profitable company. That's my whole point. And then I wanted to show you something real quick was Hims and Hers. We know what's going on with Hims and Hers, so I'm not going to talk about it. But look at the short interest. Back in February, it was up to 40% short float. So I don't know what the short interest is today, but I just pulled this up on FinViz, and I used to use this as my to find short interest. But 40%, that's pretty crazy. Did you guys know this? So that's why Hims is so out of control as a stock because it's just a really popular meme type of stock where people either short it or they buy it long. And yeah, it's crazy. Hims. I mean, I would hope you don't have a large holding in Hims because I would lose sleep over this. This post came out in Wall Street Journal yesterday. Why Blackstone and BlackRock can ride out the private credit storm. As investors pull back from private credit, having diverse businesses is key. Didn't I explain this to everybody? This was my whole point to my post that came out on Monday. It was how BlackRock, well, it was really about Goldman Sachs, American Express, but more targeting the Goldman Sachs. Goldman Sachs is so diversified. There shouldn't be that much contagion with this private credit storm. And even BlackRock, I would argue, is way more diverse than the stock selling off you would have thought. I mean, BlackRock got really beat up. And my opinion is that I'm not buying anymore. I do own BlackRock. But yeah, I mean, this sell-off it was a bit much. I think BlackRock will definitely come back, and even Blackstone will come back. It's just going to take a while for Blackstone because I think they're a little more in the heat of this, of course, but they definitely are more diversified than like a Blue Owl, right? Can we all agree on any BDC company only? Okay, so I just wanted to mention that. And this was interesting. Salesforce reportedly planning $25 billion bond sale to help fund $50 billion buyback. Again, Salesforce reportedly planning $25 billion bond sale to help fund $50 billion buyback. Moody's rating, let's see what happens with Moody's. Moody's ratings called funding the buyback via a bond sale a material shift in financial policy and downgraded Salesforce credit rating to A2. S&P Global Ratings also lowered its outlook to negative. What do you guys think about this one? What have I been saying? The only way for Salesforce to survive this AI disruption narrative is to have to lay off people. I hope they don't. I don't want to see anyone laid off. I'm just saying, I think that's what's going to eventually get these stocks to pop. Now, obviously, the ETF and software in general has the IGV, for example. We saw that bounce. What was unpopular last month is now investors go there. But I don't think someone like a Salesforce, I don't think the selling, and I'll use Workday as my other example. Salesforce and a Workday type of SaaS business, those are the type of companies I wouldn't be cherry picking. I never liked those companies to begin with. And part of it is because of such a high head count they have. Not going to talk about it. I talk about it every day. All right. And another reminder, just how huge is YouTube anyway? Well, it's the biggest. We know that. YouTube is the world's biggest media business. Annual revenue in most recent fiscal year. And you can see YouTube hit a revenue of 62.3 billion. And then right under that is Disney at 60 billion and Netflix is at 45 billion, and it goes down the list. But this is for streamers. This is just for streamers. But YouTube owns the world at this point. YouTube continues to grow. I don't see them ever slowing down. Okay, and this is cool since you might be watching me on YouTube. Of course, a lot of that YouTube money doesn't necessarily end up in Google's pocket. Well, we know that as the company splits as much as 55% of its advertising revenue with creators. So that's just a reminder. These are just revenue numbers. We knew that. Okay, and this is from March 10th, yesterday afternoon. I don't know why it's up, but maybe just a few notes to remember when you see stocks all of a sudden turning green and you think like, okay, the worst is behind us. I'm saying I would not think that. I think that we still have some troubling short-term sell-offs in the market. Trump threatens unprecedented military consequences as Iran reportedly starts mining the Strait of Hormuz. So we don't know if it's true or not, but of course that would spike oil again if it is true. So we'll know more information in the next 12 hours. And then one last thing, this is from the Pareto Investor on Substack, and I just found this interesting. He said uranium is pumping today. That was yesterday. The EU made a strategic mistake in turning its back on nuclear energy. Better late than never. But here's China's nuclear expansion between 1990 and 2031. And you can see they are really investing in nuclear. This is China. I wish, and the US really isn't, that I know of. Like the construction just hasn't started yet. They've all struck some deals with nuclear plants, but the construction itself for new, it's just infrastructure, it's just not there. Unless you guys know something more than I do, and we can talk to the guys at Stock Talk, that podcast with Phil and Eamon and Clinton, and ask what's going on. Why aren't we building more nuclear plants? So anyway, it was a pleasure today. I know one of my friends will be watching because he is interested in the Oracle recap that I gave. I didn't really give you guys like a great recap, but this is the format of the show. The show is pretty laid back, and I like to go over headlines and kind of call out what you shouldn't be concerned about. So that's what we're doing here. That's what we're doing here. So if you guys have any questions, let me know. And I got some comments the other day, but not a lot of people are watching this YouTube video. I don't know why. I guess it takes a while for it to start to suggest to people. I think the editing definitely has gotten better. I listened yesterday, and like I said, I changed the studio sound to a lower sensitivity. So when I had it at a high sensitivity, it was literally cutting out my words. So I think it's a little bit better. I still think I can improve it. And I think that you guys definitely should check out Substack in general, not just to follow me, but I'm Rigatoni Capital on Substack. And I am on YouTube and Spotify and Apple Podcasts and pretty much everywhere. And yeah, thanks. Have a great day. Don't trade anything. If anything, sit on your hands. I think you'll be happy you did. All right. Thank you so much.